threshold level in order to target any large interest payments. It provides for threshold of interest expenditure of 1 crore rupees in respect of any debt issued by non-resident society enterprises, exceeding which provision would be applicable. The bank insurance business, such as class of NBFCs, whatever by the central government excludes the MB from the said provision, keeping the view of the specific nature of this business. Also, the section 94B would also attracts the interest paid in respect of debt issued by the lender, which is a permanent establishment in India of a non-resident bar for non-resident, being a person engaged in the business of banking. Action Plan 5 counter harmful tax practices. Action Plan 5 is one of the four BMB base erosion, profit shifting, minimum standards. The minimum standards of Action Plan 5. The Action Plan 5 report consists of two parts. One part is the preferential tax regimes, where the peer review of the undertaken identify the features of such regimes and features that the base erosion and profit shifting. Therefore, its potential to unfair impact of the tax base of such other jurisdiction. The second parts include the commitment to transparency through the compulsion, spontaneous engagement of relevant information to taxpayer-specific ruling, which is absent in the information exchange, and the code gives rise to BEPS concern. Thirdly, review of a substantially active requirement in no other optional tax regimes and ensure that level playing field. Indian income taxation regime. In India, Finance Act 2016 is introduced in Section 115 BAF of Income Tax Act. Concessional tax regime is royalty income of the patents of the purpose of promoting indigenous resources and development and making India a global hub of research and development. The purpose of concessional tax regime is to encourage entities to attain commercialize existing patents and for developing a new innovation of patent product. Further, the beneficial taxation regime will incentivize entity to locate high-value job associated with the development, manufacturing, and exploiting patents in India. Section 115 BBEF of the Income Tax Act 1961, in line with the nexus approach of BE base erosion and profit shifting action 5. The nexus approach is recommended by OCDC under the Base Erosion and Profit Shifting Action Plan 5. This approach requires an attribute and taxation of income arising from the exploitation of intellectual property (IP). In education, where specialist research and development (R&D) activities are undertaken instead of judicial or legal ownership. Section 115 BAF is an Income Tax Act. Section 161 provides that 1961 provides that the total income of eligible assessee, including any income by way of royalty in respect of patent development registered in India, such royalty shall be taxable rate of 10% plus surcharge. For purpose of development means at least 75% of the expenditure should be incurred in India by the eligible assessee for an invention in respect of such patents granted under the Patent Act 1970. Action Plan 6 or prevention of treaty abuse, protection against treaty shopping and minimum standards. The bilateral treaty concludes by the judicial in the world has been served to prevent harmful double taxation, removing obstacles the cross-border trade and goods and services, movement of the capital and technology persons, extensive networks of track treaties. However, also gives ISO treaty of and treaty shopping arrangement. A treaty shopping. Inwards, attempt by a person directly access the benefit of tax treaty between two jurisdictions without being a resident in one of the jurisdiction. Therefore, the wide number of arrangements through which a person who is not a resident of jurisdiction is a party of tax agreement make attempt to obtain benefits from the tax agreement granted to residents of the jurisdiction. The taxpayer engage in treaty shopping and other treaty abuse strategies, undermine the tax sovereign by claiming a treaty benefit in a situation where the benefits are not intended to be granted, thereby depriving the justification of the tax revenues. A treaty abuse is one of the most important sources of base erosion and profit shifting concern. It is undesirable to several reasons, include treaty benefits negotiated between the parties to the treaty are economically extended to the resident of the third jurisdiction by way of parties that do not intend. The principle of the reciprocity is therefore breached, and the balance of the concession of the parties may be altered. The income may escape taxation. All those subject to inadequate taxation in the way of parties is not intended. and the jurisdiction represents of the ultimate income beneficial as a less incentive to enter into the tax treaty within jurisdiction of a source. Become a resident of the jurisdiction of a resident can indirectly receive the treaty benefits of the jurisdiction of source. These are the need of jurisdiction residents would require reciprocal benefits. Given the risk of and revenue possessed by a treaty shopping, countries are committed to ensure a minimum level of protection against a treaty shopping at a minimum standard. The commitment is required the countries to include the tax treaties and express a statement that is a common intention to eliminate the double taxation without creating an opportunity of non-taxation or reducing the tax through the tax evasion avoidance, including through a treaty shopping arrangement. The countries will implement a common intent by including these treaties. The competent approach of limitation benefit (LOP) and principal purpose test (PPT) rule. The PPT rule alone or the LOP limitation of benefits are some rule supplements by the mechanism that would deal with the conducting finance arrangements and not already deals with the tax treaties. Implementation of action choice minimum standard. The latest peer reviews of implementation of action choice minimum standards reveals a large majority of inclusive framework members have modified. On the process of modification, there is a tax treaty to implement the minimum standards and others base erosion and profit shifting treaties related measures. As the previous edition, the latest peer review report continuing to demonstrate the efficiency of the base erosion and profit shifting multilateral instrument in the implementation of the minimum standard. It is by far the main tool of the inclusive framework members by implementing minimum standard. The majority of the jurisdiction that has signed the minimum multilateral instrument has listed along almost all the treaties under the multilateral instrument. On the provision of the base erosion and base shifting multilateral instrument have started to take effect in the respect of the treaties concluded by the pairs of jurisdiction that have signed and ratified by the base erosion and profit shifting multilateral instrument. For the treaties of which multilateral instruments the effective tax administration can now use effective treaty of provision to put on the end of this treaty principle topic. Indian tax regimes. The LOP clause is introduced in the Indian Mauritius tax treaty. On the first day of the 10th day of May 2016, India and Mauritius signed a protocol amending the Indian Mauritius tax treaty in Mauritius. It is a treaty for the first time it has been provided that gains from the alienated of shares acquired on or after 1st April 2017 in a company which is a resident of India may be taxed in India. The tax rate of such capital gain arising from the period of 1st April 2017 to 31st of 19 would be, however, not exceed 50% of the tax rate applicable on the capital gain in India. The limitation of the benefit LOP a clause being introduced that provides that resident of a contraction state should not be entitled for the benefit of 50% of the tax rate applicable in a transition period if the affairs are arranged with the primary purpose of taking advantage of the concessional rate of tax. Further, the shell or a conduct company claiming to be a resident of a contracting state shall not be entitled to this benefit. A shell or a contracting company has to define any legal entity failing with the meaning of resident with the negotiable or nil business operations with no real continuous business activities carried out in the contracting state. A resident of a contracting state is deemed to be in shell constitute of a company if an expenditure of the operation in the contracting state is a Mauritius 15 lakhs or a Indian rupee 7 lakhs in the respective contracting state, as the case may be immediately preceding period of 12 months from the date of gain rise. The LOB clause of India Singapore tax treaty. On a similar lines, India and Singapore are signed protocols amending India-Singapore trade tax treaty. The capital gains on the sale of shares of Indian company by a resident in Singapore was taxable on in Singapore. In such case, the shares is acquired on before 1st April 2017 after amendment of this treaty. The capital gain on alienation of share would be taxable in similar manner as laid down in Indian Mauritius tax treaty, subject to LOB clause. The transition period respective is benefit is also similar to the containing of Indian Mauritius tax treaty respect of the share acquired in 1st April 2017, sold after 1st May 19. and expenditure and test need to be met in the 12 months of the period immediately preceding data transfer. The action plan 7 prevents artificial avoidance of pyramid establishment PE status. The tax treaty generally provides a business profit to the foreign entities to acceptable jurisdiction only to the extent of enterprise has and jurisdiction in permanent establishment to which a profit is attributable. The benefit of the definition of the permit establishments, including in tax treaty, is therefore crucial in determining whether the non-resident enterprise may pay income tax in other jurisdiction. May pay income tax in other jurisdiction. The strategy used to avoid having taxable presence in the jurisdiction under the tax authorities may cause a cross-border income and go untaxed or be taxed on low rates. The base erosion and profit shifting action plan is called for review on the definition to prevent the costs or used to certain common tax avoidance strategies used by the circumvent of a former model present permanent establishment definition. Such an arrangement, though this taxpayer replaced subsidies that traditionally act as a distributor by a commissioner arrangement, was a result of shift of profit out of the jurisdiction where the jurisdiction where a sales took place without a substantial change in the function performed in the jurisdiction. This changes will ensure that where the activities that are intermediary exercises in the countries are intend to result a regular conclusion of contracts to be performed by the foreign enterprise. This enterprise will be considered to have a taxable presence in the country unless the intermediate performs its activities in course of independent business. The changes will be restricted application number of exception to definition permit establishment to the activities that are prepared and auxiliary nature will ensure it's not possible to take advantage of this exemption of fragments of cooperative operation business to several small operations. They will also address situation where the expectation application to construct sites is circumvented through spilling up contracts between the closely related enterprises. Thus, the following steps to be advocated: rework exception to PE business, PE definition, an anti-fragmentation rule to adopt to aggregate all activities carried out by the enterprise in state along with the activities undertaken by the really closed entity undertaking business operation that creates tax mismatch or cohesive nature. The above test should also be applied to understand whether the activities undertaken by the enterprise in the state of preparatory or auxiliaries. Analyzing the arrangement entered into the contractual agreement. The commissioner arrangements are broadly defined as an arrangement though the person sells products in a state with your own name but on behalf of the foreign enterprise that the owner of this product. Though such arrangement, the foreign enterprise is able to sell the product in the state where technical having permanent establishment to which the sales has been attributable to tax purpose without therefore being taxable in the state on the profit derived from the sales. Since the person that concludes the sales does not own the product that is sales, the person cannot tax or profit derived from such sales and may only be taxed on the remuneration that is received on the service, usually commission. The commissionary arrangement has been a major cause of concern of tax administration in many various countries. Purpose of implementation of base erosion and profit shifting action plan 7. The changes in the BE definition of integration and the 2007 OECD model tax conversion in the part 4 of the ML article 12 to 15. The multilateral instrument is a flexible instrument that allows jurisdiction to adopt BEPS tax treaty related measures to counter the base erosion and profit shifting and strengthen the treaty network. The ML multilateral instruments sign near 90 jurisdiction. About half of this multilateral instrument signatures have so far adopted by the multilateral instrument articles that implement the permanent establishment changes. For detailed understanding of a multilateral instrument, refer the discussion of Action 15. Action 8 to 10. Transfer pricing outcomes in line with the value creation, intangible and risk and capital and other high-risk transactions. Over the last decades of steps into globalization of economy, worldwide intra-group trades grow exponentially. The transferring of price rules, which is the use of the tax purposes concerned with the determination of conditions, including price, transaction with the M&E groups, resulting in the allocation of profits to companies with a group of different countries. Regarding base of the arm's length principle, transaction between associate enterprises having the price of the enterprise as independent. Operation of the arm's length and engage in comparison transaction use similar condition and economic circumstances. The arm's length principle has been proven useful for practical and balanced standard of tax administration. And taxpayers evaluate the transfer prices between associated enterprises to prevent the double taxation. However, it is a perceived emphasis of contractual allocation of the functions. Assets and risk existing guidance to the application of the principle also proven vulnerable to manipulation. The manipulations lead to outcomes which does not correspond to the value creation to underlying economic activities carried out by the members of M&E groups. The aforesaid action plans represent OECD work of transfer pricing, which has been a core focus of the BEPS action plan. The action and the specific action focus on intangibles, risk, and capitals. Other high risk transaction. These are the hard areas of transfer pricing and summarizing together with the final reports aligned transfer pricing outcomes and value creation. The other risk high transactions and the business. Um, Summarizing together the final report, aligning the transfer pricing outcomes and value creation. Clarification strengthening the existing standards of transfer pricing. The transfer pricing rules. The set of the Article 9 and tax credit is based on the OECD and UN model tax convention on tax pricing guidance. You should determine the basis of the arm's length prices and conditions, including the price, transaction with the MNP, the existing standards of where the classification strengthens, including guidance on the arm's length principles and approach, ensuring approach of prices of high value intangibles as agreed upon the arm's length pricing and the working of focus on the key areas. Action plans details. Action plan 8. Address the transfer pricing issues related to the control transaction involves intangibles. Such intangibles has been defined mobiles general difficulties to value, misallocation of profit generated by the value of intangibles, significant cause of base erosion and profit shifting. Article 9. Contractual allocation of the risk are respected only when the support of actual decision makings and thus exercising control over this risk. Moreover, the Article 9 addressing the level of returns of funding provided by the capital rich multinational enterprises group members, where the returns does not correspond to the level of activities undertaken by the funding company. Article 9. Action focused on other risk areas that include a scope of addressing profit allocation resulting from controlled transaction which are not commercially rational. The scope of target of the use of transfer pricing method in way of result of diverting profit from most economic important activities of multinational enterprise groups. The use of certain types of payments between the members of the multinational group such as management fees and head office expenses to erode tax based on absence of alignment of the face valuation. The progress of implementation, additional guidance of attributable profit to permanent establishment result from changes of Action Plan 7. Final report, Article 5 of OECD Model Tax Conversion was published in the March 2018. Revised guidance for transitional profit shift method, Article 10. The print published in the June 2018 will be incorporated in the next edition of OECD transfer pricing guidance. The additional guidance addressed to tax remedy administration and the application of a hard value intangibles HTV approach and action 9 finalized in June 2018. It will be incorporated in the next edition of OECD transfer pricing guidance. The new tax prices guidance and the final transactions are published in the February 2019. That is incorporated in a new edition of OECD transfer pricing guidance. Action Plan 11, measuring the monitoring BEPS. The adverse facial and economic impact of EMPS has been focused on OECD G20 EMPS project since inception. While the ADCDOL evidence, ADCDOL evidence that shows that tax planning activities, some of the multinational enterprises take advantages of mismatches and gaps in the international tax rules and separate taxable profit for underlying the value creation activities. Addressing the basing erosion profit shifting report, OECD 2013 recognizes that a scale of negative global impact and economic activities to government revenue has been identified. Although the measure of the scale of BEP is profit erosion and base erosion and profit shifting proves challenging when the complexity of profit erosion and profit shifting gives serious data limitation. The facial effect of BEP is as significant as BEP causes adverse economic effect, including the titling of playing field in favor the tax aggregators, multinational enterprises, extra separating and the corporate debt biases, misdirecting the foreign direct investment and reducing the financing of need of public infrastructure. Measuring the impact of scale of BEPS activities that the effect of implementation of BEP is measured that important component of ongoing work of OECD 20 including the framework on BEPS. Such measurement and monitoring are necessary to inform both policymakers and taxpayers the effectiveness of the BEPS measures and the extent of the base erosion and profit shifting issue continue to exist. Indicator of the base erosion and profit shifting activity. The six indicator of BEPS activities highlight the BEPS behavior using different scores of data, employing different measures, and examining different BEPS base erosion profit shifting channels, and combining and presenting on the dashboard of indicates may confirm existing of base erosion and profit shifting which continue to increase in scale of recent years. The profit rates of multinational enterprise affiliates located in lower tax countries is higher than the group's average worldwide profit rate. For example, profit rate reported by the multinational enterprise affiliates located in the lower tax countries is twice the highest on the group's worldwide profit rate as average. The effectiveness tax rates paid in the large multinational enterprises entities is estimated to be lower than the similar enterprises, which is not a domestic operation. The titles of the playing field against local business and non-tax aggregated multinational enterprises, although same of which has been due to multinational enterprises and greater utilization of available countries of tax preferences. Foreign direct investment (FDI) is increased concentration. The FDI in the countries it means FDI of GDP ratio is more than 200% increase, 38 times higher than all the countries in 2005, 99 times higher in 2012. A separation of tax profit from the location of the value of creation activities, particularly clear to respect of intangible assets, a phenomenon of growth rapidly. For example, the ratio of the value of royalties received to spending in research and development to group of low tax countries was 6 times higher than the average ratio that all the countries has been increased threefold. In 2009, royalties received by the entities located in the low tax countries accounted of 3% of total royalty. It provides evidence to existing the BEPS, though it's not a direct measurement to scale of BEPS. A debt from both related and third parties are more concentrated in multinational affiliates in higher tax countries. The interest to income ratio for affiliate the largest global multinational enterprises higher tax rates country is almost 3 times higher than the multinational entities hold by third party interest to income ratio. An action plan to disclose aggravation of tax planning arrangement. The significant challenges faced by the tax authorities worldwide is a lack of timely, comprehensive, and relevant information to aggregate and planning strategies. The timely access to such information would be facilitate quick response to tax risks, do informed risk assignment, audits, and changes to legitimate and regulations. The action tools contain recommendations regarding design of mandatory disclosure rules, aggregate tax planning scheme, taking into consideration administration and compliance costs of tax administration, the business and drawing an expenditure to the countries who have implemented such rules. It recognizes the advantages of the tools designed to facilitate the income information flows and tax risks to tax administrators and tax policy makers. The report provides a moderate framework to guidance down to the main practice of use of countries without mandated disclosure. The result to design a regime suit that requirement of early information on potential aggravator or abuse tax practice schemes in the users. The Action 12 report set out the specific recommendation of the rules targeting international tax schemes as well as for the development of implementation of more effective information exchange and cooperative between tax administration. The recommendation of the report does not represent minimum standards and the country will decide whether or not to introduce mandatory disclosure regime. Where the country opts to mandate disclosure rules, the recommendation provide necessary flexible to balance the country to need to better, more likely information that is the compliance burden of taxpayers. It also set out a specific best practices recommendation with the rules targeting international tax schemes as well as development and implementation of more effective information exchange and cooperation between tax administrations. Action Plan 13 re-examine the transfer pricing documentation. The lack of quality data on corporate taxation has been major implementation of measure of a facial and economical effect of tax avoidance. The making it difficult to authorities to carry out transfer pricing and assignment to transaction between linked companies is more different to carry out audits. Under the Base Erosion and Profit Shifting Action towards the large multinational enterprises are required to prepare a country by country report to aggregate the data on global allocation of income, profit, tax paid, and economic activities among the tax jurisdictions and operate. The CBC report shared in the tax administration, the jurisdiction is used in high-level transfer pricing and BEP's risk assessment. The report contains revised standards for transferring price documentation, incorporating master files, local files, template for country-by-country reporting for revenues, profits, tax paid, and certain measurements for economic activities. The revised standards approach requires taxpayers to articulate consistent transfer pricing operations and provides tax administration to useful information to assess transfer pricing and other BEPs. Main determination about whether the audit resources can most effective be deployed. In the event of audit is called for providing information to comments and target audit inquiries, country by country reports will be disseminated through the automatic government to government exchange mechanism. The implementation package includes a report set out guidance to ensure that the report is provided in timely manner. This the confidentiality preserved that the information is used appropriately by incorporating model legislation and model competent authority arrangement are forming a basis of government to government exchange of this report. Requirement of OECD report Action 13 and BEP's action plan. The OECD report provides the revised standards of transfer pricing document and a template of country by country report of income, exchanges, tax paid, and certain measurements of economic activities. Three-tier systems mandated by the BEPs. The Base Erosion and Profit Shifting report recommends the countries adopt a standardized approach to transfer pricing documentation. It's mandated the following three-tier structure: master file, local file, country by country report. So master file is standardized information relevant to all the multinational information or group members. The master file requires the multinational entities to provide tax administration with high level information regarding the global business operation and transfer pricing policies. Master file should deliver the multinational engagement to directly to local tax administrator. Local file. The local files require maintenance of a transactional information specific to each country, detail the coveraging of related transactions and the amount involved in the transaction, and additional to relevant financial information regarding specific transaction, comparability analysis and analysis of election and application of most appropriate transfer pricing method used in the capture. The local file is to be delivered to multinational enterprise directly to the total actual authorities. Country by country report. The Base Erosion Profit Shifting Action 13 provides a template for multinational enterprises to report annually for each tax jurisdiction a jurisdiction in which they do business and the information sent out there. The report is called the country by country report. This CBC report. To facilitate the implement of CBC reporting standard, the Base Erosion and Profit Shifting Action 13 report includes country by country reporting implementation package, which consists of model legislation, which will be used by countries to require the ultimate parent entity of M&E group to file the CBC report in the jurisdiction of residents, including backup file requirement. The three model competent authority agreement that will be used to facilitate the implementation of exchange of CBC report in respect of the basis of multilateral convention on administration assistance in tax matters, a bilateral tax convention, tax information of exchange agreement. Following information required to be the CBC report. Information required to be global allocation of the multinational enterprise incomes and tax paid. Indicate of the allocation of the economies associated with the MID groups. The CBC report requires MID to provide the annual report of economic indicators, the amount of revenue, profit before the income tax paid and accrued in relation to the tax jurisdiction in which they do business. The CBC reports are required to file in the jurisdiction of tax residents in the ultimate parent entity, being a subsidiary share between other jurisdiction through the automatic exchange of information mechanism. Advantage of three-tier structure as per the BEP's report. Taxpayers are required to articulate consistent transfer pricing questions. Tax administration would use useful information to assess the transfer pricing risk. The tax administration would be able to make determination about their resources that can be most effectively be deployed, and the event of audit are called for provide information to comments and target audit inquiries. The Indian taxation regime. Transfer pricing provision in the Income Tax Act 1961. Chapter 10 of the Income Tax Act 1961 comprises Section 92 to 92D provides relating to the transfer pricing regime. Section 92 requires maintenance of prescribed information and document relating to the international transaction and specified domestic transaction. In the event of person who enter into international transaction, also the constituent entity to international group is required to keep and maintain specified information document respective international group. Implementation of international conventions in India. India is one of the active members of BEPS initiate part of international conventions for the purpose of implementing international convention specific reporting regime like a CBC country by country report by the master file is incorporated in Income Tax Act 1961. Essential element has been incorporated in Income Tax Act 1961, which remains aspect would be dealt with the income tax rules 2019. Refer to chapter 24 transfer pricing where the following to be discussed in length. Element relating to country by country reporting requirement and relating matter which will be incorporated in section 286 of Income Tax Act 1961. Maintenance and furnish of master file. Consequent provision incorporation section 92D of Income Tax Act 1961. Threshold limit of consideration applicable CBC reporting requirement. The CBC reporting requirement is and reporting does not apply unless a consolidated proceeding or accounting period of a year, though the consolidated financial statement exceeds the threshold prescribed. Threshold of total consideration of group revenue of the international group prescribed under Section 286 of Income Tax Act, read with the Rule 10 DB of Income Tax Act 1962 is 6,400 crores. The action plan of 440 making a dispute resolution more effective. The novel challenges are relating to the international tax surfaces necessary that a robust dispute resolution process to be placed becomes increasingly apparent. The recent statistics shows the tax administration are closely more cases than ever before. However, the new MAP cases in 2016 increased significantly, thus putting upward pressures on countries' MAP inventories. Therefore, total inventory of MAP cases being increasing every year since the number of cases closely or not being able to keep up with the number of new cases. The BEPS Action 2014 minimum standard seeks to improve resolution of tax related disputes between jurisdictions, including framework jurisdictions that commit to have been compliant with the minimum standard review and monitoring the peer through robust peer review process that seeks increased effectiveness to improve the timeliness of resolution and double taxation disputes. Objective measure to development and action plan 14 BEPS. Minimize the risk of certainty, minimize the unintended double taxation through consistent proper implementation of tax treaties, effective time resolution of dispute regarding the interpretation of the MAP. Eliminating the opportunity of cross-border tax avoidance and evasion of the effectiveness of efficient prevention of double taxation are significant to development of international tax system that facilitates economic growth and buoyant global economy. Countries concur that measures introduced to address the BEPS pursuant to a base erosion profit shifting action plan could not be result in unnecessary uncertainty from complaint taxpayers and unintended double taxation. Improving dispute resolution mechanism is therefore crucially a component of working in a BEPS issue. An action plan of minimum standard consistent of elements of taxpayers which access to judicial level legal and administrative framework in the following four key areas. preventing disputes, availability of access of MAP, resolution of MAP cases, implementation of MAP agreement, peer review implementation. The base erosion and profit safety action plan for suggests a peer review implementation to ensure adopt implement of suggesting minimum standards. As a result of peer review undertaken by India 2019 highlight the India progress in MAP program, suggesting recommendation of more effective function of MAP according to the peer review. And PEP Section 14, the Indian authority have been significant steps to reform MAP framework and make it effective. A significant role include the CBDT substituted Section 44G and omitted rule for 44H income tax at 1942. The CBDT notification 2320 dated on 6th May 2022. The new rule of 44G extensive deals with the implementation and procedural framework of MAP process. The line of BEP's Action 14 recommendation India to release a detailed guidance note in MAP in 7,020 available, and the map guidance addresses many open issues and procedural aspect of MAP, and more importantly clarify the key practical nonchious absent of pre base erosion profit shifting era, the regime for the taxpayers to resolve. The Action Plan 15, developing multilateral instrument. The multilateral instruments a role of tackling BEPs, abuse of tax practice or important source of BEPs. The multilateral instruments helps in fight against BEPS by implementing tax treaties related measures developed through the BEPS project and existing bilateral treaties in synchronized and sufficient manner. These measures will prevent treaty abuse, improve the dispute resolution, prevent the artificial avoidance of permanent establishment status, and neutralize the effect of hybrid mismatch arrangement. Action 15 of BEPS action plan provides of analyzing of a tax and public international law issued related to the development of multilateral instrument to enable the countries that wish to do so implementing the measure development in the course of the work of BEPS and among the bilateral law treaties, formulating the ad hoc groups to develop multilateral instrument. Based on this analysis, mandate to reform the ad hoc groups develop multilateral instrument. The tax treaties measure to tackle BEPS and approved by the OECD Committee on Fiscal Affairs, endorsed by the G20 finance members and central bank governance of finance 15. In line of Action 15, through the ad hoc of groups may formed with the predefined purpose of developing such a multilateral instrument and adopt the tax of convention and accompanying explanatory statement of November 16. India is a part of ad hoc groups in more than 100 countries and jurisdiction of G20. G20, OECD, BEP is associated with interesting countries, which is walked in the equal footing of finalizing the text of multilateral convention. Starting the May 2015, the text of convention and accumulating explanatory statement was adopted by the ad hoc groups in 24th November 2016. Features of multilateral instrument. The multilateral convention is to outcome of OECD G20 project to tackle base erosion and profit sharing. BEPS projects. The tax planning strategies to exploit gaps and mismatches in tax rules to artificially shift profit to low and non-tax locations where there is a little or no economic activities, resulting in little or no overall corporate tax being paid. The multilateral instrument modified tax treaties to cover tax arrangement. The cover tax arrangement is agreed for the avoidance of double taxation, that is the force between parties and the multilateral instrument. For the both parties has been notified that may be wise to modify the agreement and the MLI. MLA is a flexible instrument which will modify tax treaty according to the jurisdiction policy preferred with respect of implementation of tax treaty related to base erosion and profit shifting measure. The multilateral instrument provides the different types of flexibility. A jurisdiction can choose among alternative provision as per the multilateral instrument articles. The jurisdiction can apply optional provision, for instance, of provision on the mandatory binding arbitration. A jurisdiction can also choose to reserve the right not to apply MLI provision to opt out through the reservation. In respect of all this covered tax agreements or the respect of the sets in the covered tax agreements, the jurisdiction only have a possibility to opt out the provision and do not reflect the BEPS minimum standards, with the possibility to withdraw with reservation and opt in later. Coverage of multilateral instrument. The first signing the ceremony of multilateral on 7th June 2019. More than 65 countries signed this multilateral instrument, making it an historic moment in international tax framework. India is an active participant in BEPS programs and one of the jurisdiction signing. Even the USA, Brazil have not signed the MLA, therefore not a parties of the convention. Yes, the current status of signatory parties MLA is available. The MLA entered into the evidence avoidance taxes to a new concept of international taxation. And the fundamental of MLA is to decode the regulatory 3W1H principle. Why, what, when, and how. Why the need of a multilateral instrument and the BEP is an evolution of bilateral multilateral. But before we embark the multilateral instrument, the must understand the need of MLA under the international tax laws. The existing framework of international law is being the tax treaties entered bilaterally through countries. The MLA convention is synonymous to the treaty. Synonymous, SYNONYMONC, non-Y, moist. Synonymous to a treaty. Treaties are instruments that create international laws. In one of the most common and important sources of international law, the agreements between sovereign states are being binding every sovereign state signature to such agreement. A treaty is defined in the Vienna Convention, Vienna Convention of the Law of Treaties, commonly referred as VCLT. International agreement concludes between states and Britain form the government by international law, however embodied in a single instrument or in two or more relevant instruments and wherever in particular designation. As much as the treaties and instruments under the international law, convention, arrangement, charters are also synonymous used along with the treaties. The tax treaty framework is through countries which is entered into double tax avoidance agreement. Generally refers to DTA with several other countries or bilateral issues that is arrangement between two countries, country A and country B to prevent double taxation in India. Income. India is entered into bilateral taxes in more than 90 countries. Bilateral tax treaties are internally entered into view majority to prevent double taxation in income, gives relief to the respect of doubly taxed income. The rapid growth of globalization lead to creation of multinational enterprises wherein the setup the entities within the groups are presented all over the world and many cases due to jurisdiction which may set up the main objective to obtain tax arbitration using a treaty shopping mechanism. Consequent of 2018 global economic crisis, the International Organization of Law Nation comes up with the BEPS action plan to recognize the counter unfair tax planning and strategies adopted by certain multinational enterprises, which has exploded to gap in the global tax system to artificial shifting profits to low and non-tax acquisitions. Where there is a little or no economic activities leads to little or no tax being paid. These tax planning strategies are violated and the economic alliances and principles which means to compensate the nation or a kingdom for the benefits of one derived from exploiting a nation or a kingdom resources. This result to source of taxation principle under the international principle. As a result of BEP's Agenda 15 action plans board at OECD, G20 is mandated to tackle unfair tax factor planning mechanism adopted by the multinational enterprises. An action plan 15 can also be considered as a machinery action, which is intended to put away the play of anti-avoidance tax solution proposed to order BEP's action time. The need of such missionary action item is a base of currently there is more than 3,000 bilateral tax treaties. This is active and to invoke the solution proposed under the BEPS action plan. These bilateral tax treaties have to be amended. Amending the bilateral tax treaties involves a cumbersome legal process. Each country is having their own constitution or the legal mechanism to invoke international treaties in the domestic laws. Further, the more incorporation of the solution and domestic laws will not achieve the desired objective of the tax treaties with the remaining tools of tax evaders. Therefore, they ensure the BEP solutions are transparent into the tax treaties. The action plan of 15 objective was to bring all the amendment under the one single umbrella. Hence, the work is to developing multilateral agreements are undertaken. The multilateral agreements are undertaken or by two, three, or more nations by thus bringing many countries under this one roof. Such agreements are considered effective and less time consumption. The World Trade Organization arrangement in the India and the party a classic example of a multilateralism. Multilateral agreement is a context of international taxation is not new as there have been precedent from Scandinavian Caribbean countries entering into agreement to avoid double taxation. India is also experienced through SARSA limited multilateral agreement to avoidance of double taxation. But the distinction these agreements between through the BEPSL and MLA in the multilateral instrument exclusively entered into ensure there is a no double taxation, non-taxation of reducing the taxes, and unlike the former of the objectives interlayer to avoid double taxation and promote economic relations. Therefore, the multilateral introduced modified tax treaties not to directly amend the text for the tax treaty, but they being apply together with the relevant tax treaties. They do not make the existing DTA no what twice see, and they operate along with the existing DTA and will modify the application some clauses in existing DTA using a lex posterior later in time principle. However, the BPS MLA is effective tools to implement anti-avoidance measure to synchronize manner without the need of bilateral renegotiate each and every agreement. The BEPL MLA can act on the retainary tool for tax enforcer to use against tax evaders. It is a decentile the taxpayers from undertaking treaty shopping or availing unfair tax practice benefits based on the anti-avoidance measures under initiating under the BEPS action plan. However, seem to need to MLA tax treaties which are divide further in operation aspect of the same. Why is the MLA structure of the key organs? The MLA under the BEP's action under 15 implement and BEP's works in the existing treaties networks. The MLAs enable provide standard language modification in all existing DTA. This enable eliminating disputes arising on the account of different terms, bringing use of differently, distinctively each of the DTA between contracting states, thereby action on the different deterrence of tax abuses. Reiterated of base erosion and profit shifting a multilateral instrument enabled that existing taxpayers does not replace the existing tax treaties and operate along with the existing DTA by modifying the application or provision of under the DTA. The structure of a multilateral instrument, such as a bilateral tax treaties or arrangement, the multilateral instruments are also similar instruments and is interpretation with the government by principle laid down by VCLT. There are 7 parts and 39 articles in the multilateral instrument. The coverage of multilateral instrument through the articles light of BPS action plan structure in the manner provided below. Article 3 to 4 recognize and substantive provision under the multilateral instrument. Part 1, 2, 3, 4, 5, 6, 7. Part 1 particulars article. Part 1 scope of interpretation of terms. Article 1 and 2. Part 2 hybrid mismatches. Article 3 to Article 4. Article 4 under 5. Part 3 treaty abuse. Article 6 to Article 11. Part 4 avoidance of principal establishment status. Article 12 to Article 15. Part 5 improving dispute resolution. Article 16 to Article 17. Article 6 arbitration. Part 6 arbitration. Article 18 to Article 26. Part 7 final provision. Article 27 to Article 29. The key organs of the multilateral instrument. Each country becoming a signatory is required to adopt certain mandatory minimum standards, making notification of the multilateral instrument provision, making reservation to certain provision of multilateral instruments, and also provide a complete compatibility clause to opt in or to multilateral provision. Here we discuss the key organs of multilateral instrument. They act as a fulcrum the operation of the instrument. Key organs, converted tax treaties, compatible clauses, reservation clauses, minimum standards. Coverage of tax agreement CTA. The entire scope of the starting point of multilateral instruments revoking the CTA. The Article 2 of the MLA defines the CTA is an agreement for avoidance of double taxation respect of the tax on the income that is forced between two or more parties or two or more jurisdiction, the respect of which each party has notified to the depository or listed agreement and the multilateral instrument. It is therefore extremely relevant to those making multilateral instrument operation between two parties. The two parties, two jurisdiction or two states or each country must notify such other bilateral tax treaty while becoming a signature to the multilateral instrument. Each country has to notify the DTA with other jurisdiction under the multilateral instrument upon which such a DTA within a CTA is a purpose of multilateral instrument operation. India has notified 93 jurisdiction of the multilateral instrument at the time of ratifying multilateral Multilateral Instrument Convention. Similarly, also important that the countries that have signed the bilateral treaty in India must also notify the DTA with India with depositing its instrument in OECD. Therefore, the mismatch principle is the key approach, and only when the other countries who notifies DTA in India, the DTA between India and other India will be considered as a CTA. Examples: Exhibit 1, whether India and Australia DTA is a CTA under multilateral instrument. Steps: consideration common. Step 1, whether India and Australia already have DTA in existence? Yes. Move step 2, whether India and Australia are signatory in MLA? Yes. Both the countries are signed by MLA. Step 3, whether India has notified DTA with Australia as a CTA in its multilateral instrument deposit note in the OECD. Yes, India has notified DTA with Australia at CTA. Step 4, whether the Australia has notified DTA with India as CTA in MLA deposit notes in OECD. Yes, Australia has notified DTA in India as CTA. Step 5, conclusion. Article 2, the scope provide matching, and hence Indian Australia DTA is CTA and the MLA provision will apply. Multilateral instrument provision will apply. Exhibit 2, whether the India and Mauritius DTA, CTA and MLA. Step 1, whether India and Mauritius already have DTA in existence? Yes. Move to step 2, whether India and Mauritius are signature in MLA? Yes. Both the parties are signature in MLA. Step 3, whether India has notified DTA with Mauritius and CTA with the MLA deposit note in the OECD? Yes. India has notified DTA with the Mauritius DTA. Whether the Mauritius has notified DTA with the step India in CTA with the MLA deposit? No, Mauritius has not notified DTA with this with the governance only at the existing DTA provision. So India and Mauritius DTA as amended under 2016 internal layer incorporates certain BEPS provisions. It may be possible reason that Mauritius has not notified DTA with India as a CTA. That shows the flexibility that is available under MLA for other countries to choose. Further, there are some countries like USA, Brazil, among others, which do not sign the MLA Instrument Convention. Hence, the scenario India, US DTA and India, Brazil DTA will have no consideration towards multilateral instrument, and this existing DTA provision will only cover the tax treaty framework. Therefore, once the existing tax treaty is recognized as CTA and the MLA contract, the tax treaty will have cognizance and operational aspect of multilateral instrument. The compatibility calls a bridge between DTA and MLA. Once the existing DTA becomes a CTA, we move to the main organ of MLA. That is the compatibility clause. Once the more care objectives of MLA is ensure consistency among the nation to incorporate the solution to the tax treaties. Further, the objective of MLA is to only modify the application of certain provision of DTA. Therefore, the parties of MLA are given the flexibility to choose relevant MLA that needs to transparent to the existing DTA. This bilateral DTAs, two countries negotiate having flexibility to decide which provision to be incorporated, since the tax principles of countries varies and flexibility is too important to attract countries trying MLA. Therefore, the flexibility provided in the form of compatibility clause and the reservation clause. The compatibility clause is to ensure that there is no conflict between the two countries of DTA. DTA to ensure BTA and MLA. This is because the uniqueness of the multilateral instrument, which is not a standalone treaty as it operates standalone and bilateral tax treaties. If there is a possible conflict that may arise between the two industries, the DTA and MLA, the compatibility clause would resolve the conflicts. Further, the compatibility clause also gives option to parties to leave an existing provision of the DTA undisputed. If an existing provision serves a desired objective in the particular provision, MLA is placed to. There are 4 types of categories compatibility clauses found in the MLA convention. They are displayed in the following table. Compatibility clause, meaning, effect and notification. In the place, the purpose of the clause to replace existing provision of CTA, which is a mutual notified provision of MLA between two countries. Therefore, the concerned provision of MLA shall be replaced with the existing CTA provision. Modification right, only when both the parties of CTA notify the CTA provisions are replaced by the multilateral instrument. In the absence of the purpose of the clause to enforce a new provision into the CTA, where provisions absent in CTA. The concern of the multilateral instrument provided adding to the existing CTA, which does not contains such as a provision. Only if both the parties of the CTA modify, the MLA provisions get added to the CTA and applies to and modifies. The purpose of the clause that relevant CTA provision will be modified by the MLA provision without the replacing CTA provision. The existence of this compatibility clause is that should be a mutual notified CTA provision in which is conditions making effective. Therefore, the relevant MLA provision should be made applicable to the existing CTA provision without replacing the provision of CTA. Only when both the parties of CTA notify, the MLA provision will be made applicable to the existing CTA in place of or a place of or absence of. The purpose of clause of replacing the existing used in the place of existing provision of CTA. Number of existing provision. Further, there is no such provision in the CTA. The MLA provision will be added to the existing CTA, which is the most commonly used clause in many of the substantial provision MLA. Used in the place of as existing provision of CTAs are notified by two countries, then the MLA provisions are replaced with CTA provisions. The use in the absence of whereas no such provision exists in CTA, then the MLA provisions included them is get added in the CTA. When regarding to the notification, this is different from that is the notification criteria. In regarding to the notification, this is a different from the earlier classes where even if both the parties of CTA does not notify the clause, the MLA provision shall apply, then supersede the provision of CTA to the extent of compatibility, and the same holds good even if the one party notifies the clause. Reservation clause opt-out mechanism. The reservation provision of MLA shall not apply to the CTA if either the parties make an reservation. A reservation deemed to be VCLT in a unilateral statement made by the state when signing, rectifying, accepting, approving, assenting, and approve a multilateral instrument whereby the purpose to include or modify the legal effect of certain provision to the convention. Hence, the reservation under the treaties including flexibility to tax negotiation. So the state comes forward to the signatory to such multinational convention. The general rule of multinational instrument is that the parties are bounded by the entire instrument unless the parties make reservation. The MLI enables states to opt out of the provision either entirely or partially by introducing this mechanism and reservation. However, the reservation concern minimum standard provisions discussed later under the MLA can be only be a limited situation subject to satisfaction of both conditions. Example, India has a reserved portion of Article 3 in the multilateral instrument and transparent entities, the base erosion and profit shifting action 2. As Article 3 will not be added or modified in any Indian existing DTA as Indian as opted. The France has reserved a portion of Article 4 in MLA, the dual resident entities, and BEP's action. Rather than we apply Indian France DTA, the Article 4 of MLA will not affect the DTA, as since the France has opted out or reserved the position on the Articles 4 of the MLA. The party to MLA may reserve the right to provision of MLA do not apply to cover tax treaties in the entity to subset of covered tax treaties. The further the reservation made under the MLA by the party with applies systematically where the applies the reservation party and other party in the convention in certain exemption situation. Reservation provision also work asymmetrically with the unique factors of MLA, unlike other multinational agreements. Mandate minimum standards. The mandate minimum standards are the genesis of a MLA with the objective of MLA under the non may not be fulfilled. One of the major objective of the benefit of MLA to ensure consistency among 300 odd tax treaties is currently in existence. We have seen earlier MLA is also given flexibility to parties through compatibility and reservation clause. However, to ensure there is some consistency, party has given adherence to incorporation mandatory minimum standard provisions in MLA. The objective of the minimum standard provision is to ensure that is all anti-abuse provision will be help eliminating the treaty shopping mechanism and consequently eliminating a double non-taxation scenarios into tax avoidance. The minimum standard under MLI, therefore, the achieve certainty, consistency among existing taxpayers. The minimum standard provision, which has been incorporated into tax treaties, help of combined tax avoidance. Out of the four minimum standards prescribed in the BECD action plan, that is Action 5, Action 6, Action 13, Action 14, Action 5, countering harmful tax practices. Action 6, treaty abuse prevention mechanism. Action 13, country by country reporting. Action 14, effective dispute resolution mechanism. Action 6 to 14, a solution is specifically provisional minimum standard provision under the BEPS MLA. In this regards to Action 5 to Action 13, solution will be incorporated under the domestic laws. However, where the case of contracting states together agree to reflect the minimum standard provision specifically under the MLA into the existing DTA, then such treaty partner may opt out to the minimum standards under MLA. When I entry into force of effective date, the historic MLA signed in the 7th June 2017, more than 85 countries passed. The France, during the initial signing ceremony, entered into the force of effective date of significant Article 34 and 36 to MLA. Since the MLA is a new instrument of signing countries, many countries were not part of the initial signing ceremony have been signing the MLA on an ongoing basis. It is therefore important to understand the MLA entered into the force as effective date. The MLA will not apply to those countries which have signed the MLA, ratified the accepted abroad MLA under the domestic laws and deposited under the instrument ratified under the OECD depository. Upon deposit of the instrument ratification, the MLA entered into the force on the first day of the month of the following expiry of 3 calendar month, beginning on the date of the subsequent deposit. The effective date on the MLA is entered into the force of the contracting state. The effective date of the MLA shall be on the withdrawing tax. The first day of the next calendar year, or in the beginning of the latest date of which the conversion entered into force of such a contract in jurisdiction of city. Other taxes. Taxable parties begins around after the exhibition of the period of 6 calendar months. After the latest of the dates on which convention entered into the force of each of the contract jurisdiction is the individuation effect on the date of applicability of MLA. Date and amendment 7 June 2017, signing of MLA 25 June 2019, deposit of ratification instrument the OECD depository 1st October 2019, entering into force of India MLA. The provision of the contravention with affect the India in respect of cover tax agreement, occurrence of the provision of the Article 95 Convention. According to the exercise, the power conferred Section 19 Indian Law 130, the central government has a notification 57/19 on 9th 8 2019 available. Notified as a provision of this convention shall be given effect to Union of India according to the Indian position upon the convention set out in the annexure therefore. In a country has signed a notified DTA with India, therefore the MLA has not entered into force. In such case, the MLA provision will not be applied. For example, it has entered DTA with India CTA. However, the India has certified the MLA under domestic laws, and therefore the provision MLA can't be applied in the Italy MLA entered into force. Therefore, the MLA does not apply to respect of India Italy. Illustration 1. An Indian company intended to withhold taxes on a payment to be made to Italian company on 1st April 2000. Regarding Indian company want to understand whether the provision of MLA applicable should read with the Indian identity. Solution in the effect of 1st April 2020, Indian MLA into effect. However, Italy has not ratified the MLA on 10th April 2023. Therefore, the MLA provision of Italy does not enter into force yet. Therefore, MLA provisions are not applicable. The Indian government will rely upon the existing Indian Italy DTA. How does the MLA operate mechanism? MLA is one of the additional of existing DTA and does not replace DTA. It is only intended to modify amend the existing DTA subject to the discrimination of the parties and does read along the DTA between the parties. Thus, the unique feature of MLA is not being standalone agreement. The operation of MLA is so crucial and need proper application. The mechanism of applying MLA is satisfaction condition. Both the contracting states to DTA should be signature of MLA. Both the contracting states should duly sign DTA as a covered tax agreement and the MLA should have entered into force. The substantial provision of choice of contracting states to be analyzed through the compatible clause of notification clause regarding the provision of CTA that is to be modified by the MLA to identify whether any reservation is made in the application of the version and the MLA is either of these contracting parties.